In this video, we're going to be discussing liquidity, what it is, how to trade it, and all that fun stuff. Now, you've probably watched a lot of videos out here on YouTube talking about we have a major swing high, swing low, or even an inside swing high or swing low. Then right below or right above that area, there's liquidity in the market. Well, if you look right here at 6:30 a.m., we put in the low of the session. That was the overnight low. Then right over here at 8:30, we have news come out. The market spikes below that level. The market rockets up, and people on YouTube are going to say, look, that was nothing more than a liquidity grab. The market ran right up. Well, you know what? That is absolutely incorrect. This spike was not caused by a liquidity grab. Instead, it was caused by a stop run. And I'm going to show you guys how to identify liquidity versus a stop run in the markets. And we're not only going to look at this area right here on the price chart, but we're also going to look at other swing points so you can get a more consistent feel. Now, we talk about this quite a bit during the live stream. So if you're not yet subscribed to the channel, hit the subscribe button down below and give the video a big thumbs up. Now, in order for this to be a liquidity grab, think about this. Big institution, big players, they're looking for big volume to transact massive orders. Grab that liquidity and go ahead and make their move. So now we're going to go ahead and introduce bookmap, and I'm going to show you guys how we can actually see where the liquidity is lying well ahead of time and some tricks and how we can spot spoof orders. The dark red lines represents higher levels of resting orders. And right here at this specific price point up here, we see we have 81 contracts waiting for the market to come up, potentially fill that, and maybe we'll get an adverse reaction. Well, if we come back over and we look at this area right here, look right here, all these little bubbles going down right here basically correlates with that wick right here. Do we see any big red liquidity levels resting there? Absolutely not. Why is that? Because simply there was no liquidity there. However, this is going to be tip number one. Whenever we see a swing point broken or you get a fast move in the market, very, very small bubbles on the way down, this is a clear indication this is likely some type of stop run and the market's going to slingshot back in the other direction. Since these bubbles were shooting off to the downside, it was likely the market was going to rocket right back up. And you guys have probably seen me take trades similar to this, aka the knife catching trades out there on the live streams. So now as we come over and look at the next swing point we have in the market right here, the market came up, pulled back, little consolidation, and then the market went rocketing up. Well, how come the market just simply didn't come right up here and just fall back the other way? So now what I've done is I went ahead and brought over a book map. This swing point right over here correlates with the swing high right up in here. Now, if we look over here to the right, we only have 21 contracts sitting at that level. Does that seem like that's going to be enough resistance to stop the market and essentially reverse the trend? No, simply not. That's why we know at that point, as we're coming back up towards this area, and I talk about this a lot of times on the live stream, and this is something that we'll see quite often. When you see a swing point put in and there's a very small bubble, as we go back down and we start coming back up towards it, more times than not, we're going to break right through that level, especially if we have no resting liquidity at that price point. So now let's look at another very interesting area on the chart. And I want to pay attention to the wick of this candle. Now, this candle is actually formed at 11:15 a.m. Then the market bounced up. Now, why do you guys think the market did not go any lower than where that wick was? And let me know in the comment section down below. Do you guys think this was a stop run, or do you guys think this was actually a liquidity grab? Now, when we come back over here and we look at bookmap, all right, let's pay very close attention. Right here at about at the price point of 590, which will correlate right up in here, we did have a little bit of orders sitting there. We had a whopping 56 orders or so. That's not too bad. But look what happened. We have a big bubble, and then what happens? We get the cascade effect a lot lower. And notice how straight down the market went, and the bubbles continue to get smaller and smaller. But why did the market fail to go any lower? Well, if you look at this dark red line right below price, we look right over here to the right, we had over 100 contracts sitting there, which did what? Acted as support. The algos know there's a big potential buyer sitting at that price point. So what do? They simply push the market back in the other direction. Now, this is the type of information that traders need, and you cannot get off looking at a basic candlestick chart like we see on the right-hand side. Now, maybe you might see on a candlestick chart, once we've already formed that wick, oh, maybe I need to go ahead and jump in. However, with bookmap, we knew ahead of time that large resting order was there and that the bubbles continued to decline and get smaller and smaller on the way down, just so you guys can understand what the bubbles represent. A dark red bubble represents more aggression to the sell side. So as we're going down and the red bubbles are getting smaller and smaller, that means as we're going lower, the sellers are becoming less and less aggressive. Now, a larger green bubble means aggressive buying. The smaller the green bubble still means aggression to the buy side, just not as much. The larger the bubble, the more aggression. So now let's look at another very interesting area on the chart. And that's going to be around this swing high right over here, right around 10:20 or so in the morning. We come up there, the market rejects, we come down, and then we continue to go sideways before we can ultimately break. So why do you think the market continued to go sideways for so long, for multiple hours, before we are able to break up and through that area? Well, if we come over and we look at bookmap real quick, notice right up here, right around 10:20, as the market's running up, and again, that correlates right over here with a normal price chart. What do we see? Well, right above us, what do we have right here? We have a dark red line. How many contracts are sitting there? We have over 170 contracts waiting to sell at that level. Now, think about these resting sell orders acting as resistance in the market. So what does the market do? The market runs down a little bit, and we just continue to consolidate down here at this area. Notice we still have that large seller all the way up here at that higher price. The market makes a run up, we pull back down, and we talk about this quite often during the live streams. We have a very large liquidity level, a large order in the market. It takes quite some time before the market can gain up enough momentum to go ahead and take out that liquidity level. Then as we continue to go over, look what we have pop up slightly below that. So now we have two levels that have more than 100 contracts sitting there. So as the market was trying to push up, another big seller came in and pushed the market right back down. Now that came in right around 11:35. So right around here, as the market was going up, the big orders started to come in, and then the market ended up pushing lower, tries to come back up, and essentially will overtake this liquidity. But here's another trade that can be very useful when we're trading with bookmap. We know we have these two large areas of liquidity right above us. And now as we start to take that liquidity, look, we actually get a third level. So now we have three levels of 100 or more contracts. So once we get above this level right here, guess what? This provides a great low risk, high reward scenario. And what I mean by this is once we take this liquidity, we can essentially buy as we start getting above this larger bubble. And then we can look to target the next liquidity and the liquidity level just above that price point. Our stop loss can be right below that larger bubble right down here, somewhere in that ballpark. So essentially you have roughly a 1-to-1 on target number one, and then you have like a 2 or 3-to-1 from your initial trade location. So again, it can provide great reward to risk ratio trades. Now notice, as long as we can hold above that liquidity level, we expect the market to continue to climb up higher. And notice where the market stops, right up here, right before another large liquidity level at over 100 contracts. The market plays around there and then says, you know what? We don't have enough aggression. We start coming back down. How do we know there's not enough aggression? Look right up here at the swing point, very small bubble. We come up here again, very small bubbles. We're not seeing the commitment. Notice when we came up to the liquidity over here, notice how large that bubble was. The buyers were aggressive at that liquidity point. And this is exactly why I use bookmap in my day trading. Now, if you'd like to check out bookmap and make sure you get the best deal on bookmap, use the link in the description box down below.